Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for November 7th, 2022. We are recording this at 1 p.m. Eastern Time, and this is episode number 365. My name is David Cosbetter. I'm the creator of TimingResearch.com, and you should be seeing my screen right now. And today I have arranged for Dennis of CastAwayTrader.com to join us, as well as Michael Filighera of LogicalSignals.com and TradersHelpingTraders.com. And the Option Professor of OptionProfessor.com is back to moderate. So I'm going to go ahead and turn it over to him.
Okay, great, David. What a day. We're in a very big part of the year. We're at a very big part in the market. Got a lot of stuff to talk about, so we're going to get into it right away. But we're first going to just introduce ourselves. So, Dennis, do you want to introduce yourself and what your company is doing down there and that kind of thing?
Hello, everyone. I'm CastAwayTrader. You can find my website at CastAwayTrader.com, and my primary analytical tool is a modified version of the Elliott Wave. So it's the Elliott Wave theory with a twist. And if I have a chance, I would explain briefly what is the main modification. So basically what I do, I try to find a repeating pattern, because in my opinion, Elliott Wave theory, it's about recognizing a pattern. And once you recognize a pattern, you can make an accurate prediction what's coming next.
Sounds great. And Michael, quick background on yourself and what's going on at your company.
Okay. Again, Michael Filighera. I am been trading for over 40 years. And again, similar to Dennis, my main tool is Elliott Wave and Fibonacci. So again, it could be a very interesting conversation today. Although my basis in Elliott, I tend to stick to R.N. Elliott's work versus some of the other additions that have been made to Elliott Wave. I'm more of I stick to what Elliott said versus what somebody else may have added. So this could be very, very interesting. What's going on in my company? Just building on that, I continue to have daily updates and I post them on my YouTube channel. And that is continuing to go really well. And actually that's about it. And I'm starting to actually put together my podcast, which is Eye of the Storm podcast. I do them now, but I'm beginning to load up guests and getting those recordings done and get those posted. So that's what's going on with me.
Sounds good. All right, guys, we're going to hit the Elliott Wave. We're going to hit the Fibonacci's. And of course, I like to follow moving averages and the relative strength index. So I'm going to look at some of the stuff that I'm at and seeing how it fits in your stuff, which I think is important. But we've got the stock market. Obviously, a lot of people are touting a big year-end rally. That seems to be having a little bit of hard time right now getting traction. So let's, you guys aren't looking at anything fundamental that much, but we do have an election tomorrow and we've got the CPI coming out on Thursday. So we certainly got a lot of action this week. Let's start out with the stock market. The S&P 500, we're basically in the 3,700 and change area right now. And we had a big rally up to 3,900 and change off 3,500. Let's start out with Dennis. What are you seeing on the Elliott Wave? Can you share charts with us and explain how you think things are going to unfold here?
Okay, so should I share my screen?
Oh, absolutely. Otherwise,
Yeah,
we're traveling blind. Yeah.
Okay.
It's always nice to see the graphic and your explanation of the graphic. You know what I mean?
Do you see my screen now?
We do. We see something that says scenario. It's bouncing around quite a bit. Yeah.
So first of all, I think that the stock market made a major top in January 2022, if to speak about ES Mini or S&P 500, and if to speak about Russell or NASDAQ, I think we topped in November 2021. And this is how, this is the main fractal, which is recognized by the Elliott Wave theory. This is so-called 5-wave up fractal. The classic Elliott Wave theory believes that every move up by 1, 3, and 5 should be composed or subdivided into 5 microwaves. And the modification version of the Elliott Wave theory, which is called the harmonic Elliott Wave theory, which I've been practicing. actually believes that it would be too great to be true, if you could get all the time 5 microwaves inside those waves 1, 3, and 5, but it's much more reasonable to expect that market actually moves in ABC structures all the time, either up or down. And this is the main modification. So looking at that fractal, I can make a case where all the indices made a major top. And in the same way as the classic Elliott wave theory, we believe that once a 5-wave up fractal is completed, we should expect a corrective ABC move down. And what's really important is that when we get a major top, which is shown on that chart for ES mini weekly chart, we normally expect a large ABC down that ultimately targets the low made by the previous pullback in wave 4 or 1 degree lower. And I want to remind you that the previous low made by wave 4 or 1 degree lower was in March 2020. That, like flash crash, as people call it, the pandemic low, as I call it. So in my opinion, the ultimate goal of that move down would be something from 2600 to 2200. And the question is how we can get there. There are 2 main paths for any corrective structure. It could be, so here we do not have any difference in between the modified version and the classic version. So we treat corrective structures in the same way we normally observe the same types of pullbacks. So we recognize 2 main structures, either 335. So it's like ABC down. This is leg 1. We label it A. It's followed by a pullback ABC up, making either a higher low. Normally it's a lower high, but sometimes it just retests the previous high or even make a slightly higher high. And then the final leg down, normally the strongest one, which is composed of 5 waves. And it's strong, and in majority of cases that second leg down would be much stronger than the first leg down. And for example, this is how it worked out in 2008 and 2009. We got ABC down, that was first leg. We got a corrective ABC up, that was wave B. And look at that wave C. So that wave C was 223.6% of that first leg down. So it was bigger, more than 2 times bigger than the first leg down. And there is probability that ES mini and S&P would be following that fractal. And for example, if we look at that pattern as a repeating pattern, we could say that we might be here and a huge strong drop is ahead of us. But it's a simple 335 structure, and I know that many people expect that. And in my opinion, when too many people expect one resolution, normally it does not happen. So this is why I tend to think that we might be following some more complex so-called 333 structure. 333 structure is starts in the same way. It's ABC down, this is first leg. We label it W instead of A. Then we get ABC up. Instead of B, we call it X. And then instead of 5 wave down, we could get only 3 wave down, where wave A might be bottomed. Then we got ABC up that might be topped early in late October. And we may be starting the final leg down. So basically, in the bigger scheme of things, it offers the same resolution, another leg down, and that leg down, subwave C or wave Y, would kind of complete the whole large corrective structure that follows a big rally that started in 2009 and topped in January 2022. But, I have different scenarios, as I've shown you, and all the scenarios actually assume that ES mini and S&P 500 have room to go down. Either they could go down like directly in the very bearish scenario, or we could drop to 3,600 something, find support or make a slightly lower low here, bounce again, and only then start an accelerated move down in a microwave 3. So for example, for NASDAQ, I have a similar set of counts. We can count it as 333 structure. Again, ABC down, it's W, ABC up, it's X, and it should be completed with another ABC down that compose the final wave Y. And here, we can make a case where one more push down to, let's say, 9,800 would be a big support, because this is where September 2021 correction found support. Then we could get a nice bounce, tradable bounce. We could call it Santa's rally into the year end, and that would be wave B. And then we would get the final climatic, push down that would wash out, all retail, and that would liquidate all longs. So this is where, the bearishness would actually peak, and probably VIX would finally rally.
So basically, you're thinking that there could be a year-end rally going into January, and then sometime in Q1, we could get another further deterioration.
I would say if we have a rally, I would expect it to top either by the year end, or maybe like the beginning of February is the latest. And I think, in the first quarter, we will start a slide down again, because now what holds the market up is that, we still don't know whether recession is coming. I mean, I think recession is coming, but the market keeps, betting money on a scenario where recession would not come. And if recession would not come, we dropped enough historically for a pullback without a recession. But if recession would be proven in the first quarter of 2023, so we would definitely have a lot of room to go lower, because historically, when recession is confirmed, the market could go down and erase up to 50% of the preceding rally. And this is when the market, would go really bearish and would be able to make that accelerated move down.
So the scenario, like I say, it does look like it could be optimistic going into the end of the year. Is there a level where you'd like to see it close? Like, let's say we're using S&P. Is there a level on the S&P where you'd like to see it closing above to kind of confirm that we might be actually seeing it? Because my level is around 3850. If we can get above 3850, I'll start becoming a believer that there is a rally coming. Until we get that, I'm a little suspicious of all the optimism going into the end of the year. So do you have any kind of a number that might confirm that the train is leaving the station?
I'm a big fan of looking at moving averages in addition to waves, because this is what the majority of other traders watch. So like 95% of traders do not know how to count waves. So we would normally look at waves, at moving averages. And looking at moving averages, we are kind of at the crossroad. We can see that on a daily chart, S&P is squeezed in between of 50-day moving average and 21 EMA. And basically, once we close over that 50-day moving average, that would be a big argument in favor of the bullish scenario. But what's even more interesting is the weekly chart, because we can see that 2 previous weeks we got rejected of the 21 EMA weekly. It's around 3890. And basically, if bulls manage to close a week over 3890, I wouldn't be fighting that trend. So most likely that would confirm that something much more bullish is going on. And because once we close over 3890, then it would open the door to test 50 MA on a weekly chart, which is way higher.
So basically, your number is more important at the 3890 area.
Yeah,
I got you. And of course, like I said, I also saw a gap around 4100. Did you see a gap back in September around the 12th or 14th on any graph that shows a gap at around 4100? You see that right there?
right here, you mean in September?
Yeah. So is that a gap that might be an attractor?
Maybe, yeah, why not?
Yeah, it's a possibility because these gaps tend to get filled, right?
Yeah, there could be like, it could be A up, B down, and then 1, 2, 3, 4, and 5. But that drop, it looks too big for basically for wave 4. And at that moment, if I look at the micro chart, so basically, I only see a bearish scenario going on because we got like an overlapping consolidation that's going on after the drop triggered by the bearish FOMC. And by now I can only count it as a 333, micro 333. And yes, the bulls can push AS to 38.14, maybe to even 38.30 today or tomorrow. But that's actually an ideal looking short setup to me at the moment. Because once we break under 37.20, we could quickly drop to 36.20, 100 points in a heartbeat, because we need like a big air pocket underneath.
Yeah, there is a lot of people positioned, I think, now for the end of the year rally. So if we were to start breaking under 3,700 for whatever reason, they could change their tune pretty fast.
Yeah, so if we drop and shake them off first, then we could actually find a new bottom in 3,600 region. That would be an ideal scenario for me. And then, it could go up. The only bullish scenario I can see here is actually in NASDAQ, because in NASDAQ, I can make a case, that, for example, so my primary case is that on a micro scale, if you look at 15-minute chart, again, we are setting up for another drop because of the low made by the post-FOMC drop last week. We got a very corrective looking WXY structure that can push higher one more time to 11,040 today or tomorrow. But so far, it looks really bearish to me, and it looks like, it can go down, it can break under 10,600 and go down to 10,400 or even under down to 10,000. So on a micro scale, everything looks bearish to me.
Are you looking at the Treasury note? Because my feeling is to get this rally that everyone's looking at, the 10-year note has got to drop either under 410 or 390 in order to get a little bit of relief on the interest rate front. Without relief on the interest rate front, I'm thinking that the rally cannot happen.
Look, I look at US dollar index DXY, and for example, we had a beautiful setup last week to start a rally, but I showed to my subscribers an alternative triangle count. So in my opinion, rally in US dollar has not tapped. I think we are consolidating in wave 4, A, B, C, D, E, and so we are in the final push down in subwave E, and I expect it to bottom somewhere here, close to blue line, and then it should spike again. And if US dollar goes up, so basically that means bearish for equities.
Right. Yeah, because again, the US dollar getting underneath that 111, 112 area, that stimulated all that gold buying, that stimulated all that excitement. And if that is just a little bit of a dip and they're going to bring it right back above 111, 112, then obviously these people that are positioning for the dollar dropping to 104 are mispositioned, and then of course they would switch their position.
But you know what, at the same time, I'm super bullish on gold because gold and gold miners really look bullish, and they look like they have a long-term bullish scenario. I can show it to you if you want.
Yeah, let's show it real quick. Yeah, and then Michael can get in there and he'll show us all his stuff.
So this is GLD 60. Let me show you a daily chart.
But if that dollar is only going to dip a little bit and then go right back on the bicycle, that could be difficult for the mining shares, which might, just be seeing a lot of short covering.
Yes, absolutely. Yeah. But, looking at, at that structure of the top made in August 2020, we got a very clean A down, B up, C down that dropped into my green target box. And you can see that 100% extension of wave A This is 123.6% extension of wave A. So that was a target box, and we are talking about a huge pullback that took almost 2 years. So that's at least like some kind of wave B, and I would expect bulls to be able to push higher to a new all-time high after that. Yes, there is a chance that, you know, we could get a bit deeper into that green box, but in my opinion, it looks like pretty bullish. And if we look at 60-minute chart, so gold violated that red trend line, and I could easily count 5 waves behind that sub-wave C of a large wave B. And a similar bullish picture we can see on GDX chart. So I was thinking, I spent a lot of time thinking how, you know, just to count that craziness. And in my opinion, it might be a huge wave 1 up, followed by a huge corrective A down, B up, C down. So it looks like pretty neat. And it dropped to 66.7% retracement, which is a pretty common retracement ratio under the harmonic Elliott wave theory. And you can note that subwave C stopped at 123.6% extension of subwave A. So this is a great confluence of fibs, retracement fibs and extension fibs to paint a green target box for me. So I would expect bulls to be able to start another rally, at least to retest the previous highs, maybe 40, maybe even 47. But
now, could you just put up a chart on Newmont Mining, which is a big component of this, because Newmont Mining pays over 5% dividend, and they have a record date coming up on December 8th, and it really flushed them down to about 30 NEM, yeah. Yeah, it flushed everybody out pretty good. Can you see that? The 37 number. And this thing pays dividend while you're watching gold do whatever it does. So getting a good cash flow plus getting something that is about 50 cents on the dollar from where it was trading. It's an interesting thing for me to look at. I was wondering if there's any evidence that there's a good value down here, because that heavy dividend, in addition to owning the gold, I think they have 6 million ounces of gold they're going to create this year, which sounds like a lot to me.
Yeah,
see the yield 533.
Yeah, we can actually attempt counting it as 5 waves down, like 1, 2, ABC of 3, 4, and 5, and then an expanded flat structure, A down, B up, and C down, like a huge expanding flat. So that might work, but at that moment we can see that what I would be waiting for, I would be waiting at least for it to go over 8 EMA weekly, and it's still under that level. Let me zoom in.
What's that number translate to?
So it's 42.17. It's very close. It's just 2% up. And
so if you see a 43 number, it'd be a green light for you.
Yeah, and for example, and looking at daily,
because like I say, when you can get 5.33% yield and you get something that's producing 6 million ounces of gold, and it's at 50 cents on the dollar from the high, and that wick seems awfully long, doesn't it?
But I think, you know, from in my experience, you know, those big miners, and that one has a market capital of 32 billion, would be much slower than numerous junior miners that would be flying like 10-20% a day.
Oh, you know, no doubt about it. Yeah.
Yeah, it depends on your
yeah, it's all according. Do you want to get, are you interested in getting 5.33% yield and a very large company with a large amount of gold they're producing, or would you rather go the more speculative route and get a lot more action on your money?
I am a trader. For example, if I look at Nugget, which is triple ETF, we can see that it has already broken over 50-day moving average. Look at that volume, that spike and that spike. So we definitely see some accumulation going on, and looking at GDX, we kind of see the same good sign. Like, look at that candle. So basically we see that, you know, people are buying there with two hands.
Yeah.
So they look much stronger than NEM.
But a lot of it has to do with the fact that the dollar index dropped under 112,
Correct.
111. And
Of
if
course.
it does not stay under there, these people could change their tune.
Yeah, so basically the main problem now is that DXY count. And to be candid with you, even looking at 10-year yield, I could make a case that it has a lot of room to go higher.
Mm-hmm. The 10-year yield to go higher?
Yeah.
Yeah. And of course, that would be a little bit restrictive on some of these things, right?
For commodities and for equities, for sure.
Right.
So basically, some of them lie to us. So
Yeah.
maybe those precious metals, they try to start a rally so many times over the previous couple of years.
Right.
So we need to see, some confirmation.
Yeah.
And another bearish thing what I can testify to is that, for example, silver does not look having bottomed. I would expect at least one more flush down in silver. And it might happen that gold would be meandering without making a new lower low, waiting for silver to make a bottom. Because, silver, for me, I don't want to buy it yet because it seems like, so it has a similar pattern, A down, B up, but looking at those 5-wave down, we got 1, 2, ABC of 3, and that consolidation looks like a textbook microwave 4 up, which actually argues for another push down in wave 5, and that wave 5 down may come as a flush that can go as low as like 1490 or even just testing 14. And
Gotcha.
that would be like a brilliant opportunity to go along, in my opinion.
Yeah. This did feel a little like a short covering rally in the silver, didn't it, lately?
Yeah, but again, for subway, so I expected it to stop somewhere here.
Yeah.
But for around 1870. But the strength of that move up, frankly speaking, does not fit well that count. So it should have stopped and turned down a while ago. So it becomes
it's overshot.
It becomes too big for wave 4. This is a problem.
I got you. Michael, I'd like you to chime in here and get your views on how not only your Elliott Wave analysis looks on the stock market and gold, but also on the Fibonacci number, if you have those projections.
I do, but I need to change screens here.
Yeah,
So.
and then you could share your screen and show what your analysis looks like.
Can't do it yet. There we go. Let's go over to this screen. Well, I'm going to start with the S&P, and the S&P, I do not use harmonic. I actually do not consider it Elliott Wave, because Elliott Wave does not have WXYZ and have a lot of the things that are included in the harmonics. So what I do agree with what was been presented is that the markets did top, and the S&P topped in January of this, when was it, 2022, I guess. Whatever was the major high that we had, that was the top. But that's where I consider on an Elliott basis that we finished up to and including a super cycle wave 3 advance. And that advance actually began in 1932. So we're in a very large corrective period. Within that corrective period, that it will all fall in 3-wave structures, and they can be differences inside there. So what I've got coming into today, and I'll just go out to the weekly chart so we can see that high. That high here finished all what I had just mentioned. Let me go take rid of these for right now since they don't make sense. So what we're really coming down in is we have several levels to complete. The ultimate correction is going to be a super cycle wave 4. Inside of that are going to be 3 waves labeled ABC of cycle degree. Within that are going to be 3 waves labeled primary degree. Within the primary degree is going to be 3 waves of labeled intermediate degree. So now let's count back up. So we have the first ABC, which are the yellow, and that's the intermediate degree. That formed primary wave A. Then we had, again, intermediate ABC, and that formed primary wave B. That was the rally. So this low was in June of this year. That high was the August 16th high. And it was nothing, it was just a corrective bounce. And now that we are tracing and tracking out a primary C wave decline, within that primary C wave decline, there will be 5 waves of intermediate degree, of which thus far we have completed. I'll go back down to that daily so it makes a little bit more sense and becomes a little bit clearer. So we have intermediate wave 1 complete, and that would have been complete at the October 13th low. And then we bounced off of that and we completed the intermediate second wave, and that would have been just last week at the November 1st high. And now we are dropping in the beginning stages of an intermediate third wave. And that intermediate third wave, I'll just kind of throw on some Fibonacci extensions, which is what I use to forecast levels for something that has not occurred. And so, right there, thank you. So basically, if wave 3 were to be equal to wave 1, which would be the absolute minimum, that's going to take us down to 3102 or 3100. But being that the third waves are normally the longest and the strongest out of a 5-wave sequence, and 5-wave sequences, in the only way it can be labeled as an ABC is if it falls within the A wave or the C wave, because then it could be a 5-3-5 type of a structure. But if we're counting an impulse move under the way that I do it and under the way Elliott wrote it, there isn't like 5A and that they don't all turn into ABCs. Now, maybe on a different methodology, such as what was presented, that's the way it's done. But in Elliott himself, that's not part of Elliott's original work. So if within this third wave, Elliott notated many, many times that the third wave is often the longest and the strongest wave. And the reason is because it's going to subdivide within itself. So when we get down to that 3 of 3 move, it's going to produce an extension within this larger leg coming off. So I normally would start to look for a low. Once we start to break below this, depending on the structure itself, I would be looking for a move down to at least 3,000. And then we get another bounce off of 3,000, and that's just going to be an intermediate 4th wave. And we still have an intermediate 5th wave, which I believe will bring us down to about 2,800 down to 2,600. And that is then where I see the completion point for that cycle wave A. And again, I got to go back out to my weekly chart so that you can see that, right? The red is the cycle. I'm looking for the cycle wave A to complete. Now, mind you, once that is complete, what it does actually tell us as far as the market is that we're going to get a cycle degree B wave rally, and it's going to be huge. If this was the primary B wave rally, consider that the cycle B wave rally is going to be about 10 times as large. And it will also form an ABC structure, but it's going to be one powerful rally back up. Now, people will say, what's going to trigger that? Well, we can postulate and talk about that, but the reality is like what we're looking for is, again, for the Fed to ease and things of that nature. But I still see that we still have plenty of downside to do before. So when we want to discuss a Santa rally and end of year rally, I think it's going to be very, very muted. I think we will see some of it, but right now I'm seeing more of it in as rotation out of tech and into mid cap. I've seen a lot of that happening. So that actually kind of produces a year-end rally for the Russell versus one for the NASDAQ or the S&P. I also see possibility that it may come in the Dow stocks, but again, you're talking 30 versus 500 in the S&P and 100 here in the NASDAQ. So I find that tech is very weak, and we may not see what people might be anticipating in the NASDAQ. I think what we got going on against that is the continued battle with inflation, the continued battle with how high rates should get, the continued battle of the demand from the public of, well, you got to pivot, Fed, you've got to give us a break. And I don't see any of that happening. Now, you mentioned just before that we had that tremendous rally in gold, and you talk about the dollar. And what I want to interject is something, I don't know if you heard about this, Jim, or not, but I wanted to bring it to your attention that the Central Bank of China has now released and implementing the digital yuan. And that's a major, major step in them dethroning the dollar as the international currency of trade.
Yeah, they obviously would like to do that, but it's unknown if that's going to be successful. You know what I mean?
I understand,
Yeah.
but right now it is being very successful.
Yeah.
They're already accepting.
One point you
payment.
made, I think one point that should be highlighted that you made is that tech is definitely a big part of these S&P indexes, and tech is definitely under pressure because of oversupply things now.
Right.
And so basically the money is already going to the banks, the dividend payers, and it's going into the industrials because they're obviously thinking that maybe infrastructure will be done next year because it's a bipartisan no-brainer. And so bottom line is we're already seeing people dumping out of the tech. And as we go to the end of the year, these people that are trying to get performance and stuff, they're not going to stay with stuff that's going down. They're going to get into this stuff like dividend payers, like industrial stocks, and like these financials, these banks, because, you know, the net income money that they get now, because they can get 4% on T-bills off of everybody who leaves their money in the bank earning no interest.
Right.
So their returns are going to be great. And the energy sector, obviously, you can see today still has quite a bit of legs. So energy, industrials, and financials is definitely where the money seems to be leaving the tech and going there. And you can see it in the results, you know.
So it's just a rotation, right?
Yeah, and I saw that rotation in August because in August I told everybody that the growth to value ratio said dump
Right,
growth and
right.
go to value, and that has
So
been
what was your
that has been
connection
genius.
then? What's your connection then to the dollar?
Oh, my connection to the dollar is none, but my connection to value over growth has been very high since August, and it's been a very great switch because everything that has dividends and stuff like that and low PEs, they're the ones that actually are either going up or not doing too badly compared to your
So in
Metas,
essence,
your
then-
Apples, and everything else. Yeah.
Right. So in essence, then every time the dollar gets sold off and they buy the market, that has there's nothing. That's just a folly.
Well, no, I
That's
mean,
just-
they're buying the market because when the dollar does back off a little bit, it definitely helps the multinationals. So obviously that's good. But the problem is that 10-year note stubbornly staying above 390 and actually going up to higher yields today is very hurtful to the stock market. And that's why we're underneath 38.50, because if we can get that 10-year note under 390, then we're going to get this 4,100 on the S&P, I think. And
Why would we get the 10-year note under 390?
only because it looks to me like inflation did peak in May and June. And if the CPI numbers started to show a 7 print or something like that, it would get the yield. In other words, if the Fed's not going to 5%, but they're only going to go to 4.5 on the Fed funds.
So what about the talk?
Then the
that's
yields
out
are
there
ahead of
saying that
the yields are
Fed's
ahead of
going-
themselves, huh?
What's the talk that the Fed will raise the target?
Well, the Fed has raised the target, but again,
To
the
what?
Fed.
What have
well,
they raised the target to?
I think they're at 4.5, 4 and
No,
3/4.
no, the inflation rate.
Oh, the inflation rate, obviously they're looking for a break in that. And like I say, there is a outside chance they would get a break in that at some point because of the fact that manufacturing has clearly already rolled over, because obviously they're not going to manufacture a lot of stuff into a slow economy. So manufacturing has already rolled over. The one thing that hasn't rolled over is the services side. And that services side, is the next one to roll over.
I understand, but my point to a lot of this, of what we're talking about, is that when we have to consider, it's like, well, if we can get this down below 390, that'll be bullish. It's like, why would it go below 390?
Well, it's the same reason back in June, it went from 350 down to 250 out of the blue. You see, I mean, when there's an order imbalance, everyone is obviously short the bond market again very heavily. And if anything were to come out to
Right. So that's what we
yeah.
need to add. We have to realize that it's like, it may have nothing to do with inflation. It may have nothing to do with
it's
the
technical.
goal.
It's technical.
It's totally technical.
Yeah.
Correct.
In other words,
And
if you get,
but I think we need to
Yeah.
make that difference.
Yeah.
Because we don't have any evidence on the inflation front that
no,
we
No, we
really
have
should
none.
get lower rates.
No, and forget about lower rates. We're talking about a technical bounce here. We're talking about like in June when it goes from 350 to 250 because of some short-term phenomenon. Like,
Right, right.
and again,
But right,
we're up at
but
480.
right now,
We're up at
I
480
don't
on the
disagree
2
with
year.
what you're saying, but right now
Yeah.
I actually don't see that.
Well, here's the deal. We're at
And
475 on the 2 year and
Right.
480 on the 2 year, and Fed
Right.
funds is at 375.
right,
So that by definition is telling me that we are way ahead of the Fed. And if we're way ahead of the Fed and the Fed comes out with comments of we're going to go up to 450 by the end of the year with a 50% move in December and a 25% move in January, if that unfolds as the truth, then these yields are getting way ahead of themselves, and that sets up your correction in yields, and that would set up your rally in stocks.
right. I agree with you on that. It's just, I think what we really need to focus on is that I'm not expecting that big of a correction, either in rates or just relaxation or just things of that nature. I think that the Fed backs itself into a corner to, to kind of keep things on an even keel, because the last thing anybody wants is a panic, an outright panic.
Right. And
But
if
what
there is
I
any
do
kind of
see
a
coming
panic,
in-
and if there is any kind of a panic, Yellen has already said that she is prepared to buy treasuries if the markets become unsettled. Like
I
just like
wonder
the
whose
Bank of
money
England
she
did, just
intends
like the
on
bank.
using to buy those.
Well, they'll just do what Bank of England did. They'll do temporarily
I
print
know.
money. I mean, that's what Bank of
yeah.
England just did. The Bank of England just went from we're in the tightening mode to we're going to buy bonds because it's an unstable market. Well,
Right,
if
yeah.
if the markets become unstable there, what Yellen is saying is we're going to do the same thing. And if
I
they
agree.
do that,
I hear what you're saying. Now, I think in the terms of gold,
yeah.
what would you credit the $50 rally in gold to?
Well, first of all, it would be short covering and the fact that the dollar index dropped under 111, 112. I think that 111, 112 on the moving averages that I work with was a very important level, and they could see, and the RSI broke under 50, so they could see that that was a technical change in the dollar. And if you see a technical change in the dollar and the whole world is short these metals, they're going to want to cover them. And when they want to cover them, the liquidity in the metals market stinks. So obviously, if everyone is covering their shorts, the guys on the buy side or on the sell side are going to raise the offer.
I agree.
Let all these shorts
But now
cover.
I'd like to just add one other thing, if I may. On that day, that's the day that the Bank of China made their announcement on the digital yuan. And they also stated on that day that their full intent is to back that yuan with gold. Now, what happened on that day? They came in and they sold the dollar so hard. I was like, whoa, what's going on? Maybe it's an intervention. I did not know. But at the same time, I'm like, whoa, look at gold. Now, just saying, could that have been a possibility? And
well, I mean,
then
like I say, China,
we saw the bond market on the same day from being slightly unchanged to maybe a little higher to suddenly dropping massively and then recovering.
Yeah.
So could that have been Yellen from the Treasury coming like, oh, come on, we're going to go in and we're going to save this? Possibly. But I think what is more important is the underlying message. And I agree with you on the dollar, but I think the dollar tops out at 120 and then backs off. I mean, truly then comes down. And I think that's when we'll get this magnificent rally phase that is going to be longer than just a month and a half or the 3 months that we've seen, June to August that we saw, et cetera, et cetera. So I think that we still got a lot of adjustment coming. I do think the year-end adjustments are, like we've already said, they're going to be dumping tech, and they're going to be a lot of tax sales. So, we got that to deal with. Et cetera, et cetera. Right now, we're looking at Apple, that they've got supply problems. They've got a distribution problem because what they're referring to is that China's and their COVID restrictions. So they're unable to take delivery of the iPhone 14 and the iPhone Pro and Pro Max.
Yeah, I mean, that's all dust. I mean, that's all dust.
It's not all dust because somebody just lowered their estimate on earnings.
No, what I'm saying is it's dust. I mean, the iPhone 14 is totally not happening. So that, but here's the thing is, in China, with their real estate problems, with their other problems with unemployment between 18 and 25-year-olds, and a whole bunch of other things, they may not be in a dictatorial position, to be doing any kind of a change of the currency and stuff like that, because there has to be a confidence in the people backing the currency. And if you take the digital aspect and the communist country aspect, you might have a hard time forming a conga line behind any kind of currency that China comes up with.
I understand, but I'm going to tell you that this is something that they have been working on for a very long time.
Yeah.
And I do believe very strongly that they know they can't win a war.
Yeah.
A physical war against the United States or NATO or whatever we want to include. But what they can do is they can win the economic war.
Yeah. Well, I mean, after the experience that Germany had trusting Russia on their energy, it might be hard to convince people to trust China on their entire currency backing.
I agree.
That would be my
right now it
experience,
seems to be
feeling.
kind of, we'll see, because I don't disagree with what you're saying. It is a wait and see type of a thing, but I'm
Absolutely.
saying when we're looking at what's happening in the market,
Mm-hmm.
and we're trying to interpret this against what we can see coming,
Mm-hmm.
I think that we have to consider that. I think we have to consider some of the gyrations that we've seen. So, you and I know from my point of view, I've been a gold bug for so many years.
Well,
I am
sure.
not necessarily ever really going to be bearish on gold, although
No.
over the short term, I agree. Now, whether gold has actually reached its bottom, because it got down to fib levels for me.
Yeah.
I'll just kind of go over there.
No, those numbers look pretty good. By the way, I'm noticing Bitcoin and Ethereum, which had very big moves, have reversed a little bit today. So
Right.
I don't know if that's going to be indicative of what the markets are going to do as far as stocks, or even
I
if
find it
that's what
very
the
interesting.
metals are going to do.
I find it very interesting that, because I agree with you, but what I noticed is that Bitcoin and Ethereum didn't react in the same way as other things that the market and the dollar truly reacted more strongly to. And Bitcoin kind of sat there and gave a peak. Now, normally you would think that being down 420 is really nothing for Bitcoin, but so we've not really seen that in a truly negative market that we have seen in the past.
Yeah.
That Bitcoin has dropped like down over $1,000 again, like we've seen. So I agree that I'm not really sure what's
The follow through on it is making it reek a little bit of like a short covering rally that is now an ending.
Could very well be.
I mean, that's the risk, I think, right now when I look at that.
I agree with you on that statement.
I can share with you Bitcoin, because I think that, frankly speaking, Bitcoin is setting up for the final flush to 12,500.
Okay.
Yeah, like I say, it definitely does seem like it's near the lower end, but I mean, the action is of Friday, which was so exciting in copper, so exciting in silver, so exciting in Bitcoin and gold.
Right.
And the lack of the follow through on here Monday. And if it fails to follow through this week, I think it would be disappointing.
I agree. But I think that there was the chance that it can get down, but you see, it kind of came down to where it should, where this corrective phase would be equal. The drop is equal to the A wave. And that's all I was really looking for. It dipped down below, now it's back above. And it did it real quick. So I agree with you on the short covering, Jim, absolutely 100%. And we both know, because we follow gold long enough, that once that begins, there's no mercy.
No.
There's no mercy, and they will force it. They will force it. As I saw in Apple the other day, on Friday, they took Apple from 142 down to 134 and then raced it back. And why? What was expiration? Why? Well, they did a gamma squeeze on the shorts that were in the short 140 put, drove it all the way down, forced them to cover everything, and then ran it back.
The other thing is the major trends on this stuff is definitely down. And when you get this far away from the averages, you are going to get some reversion to the mean rallies. But you have to be careful, because if you buy a reversion to the mean rally, I mean, as you saw at 4,600 on the S&P earlier this year, or 4,200 on the S&P, I mean, you're going to get your head dunked right back underwater, because, if the major trends remain down, these bounce back rallies look very, very good. But if they don't last, you're really going to get nailed up buying strength on a down market.
And what does concern me, the fact is that the weakness in the
Yeah.
NASDAQ. It's palatable. It's very palatable. And so that, because of how they have now balanced these indexes and how the weightings in these indexes, and that still you can look at the S&P, and the number one and the highest weighted stock continues to be Apple. Now it's kind of working against them instead of with them, right?
No,
If it's
because
in a bull
the
market, oh, yeah, we
managers
wanna
that follow
give-
the managers that have to produce gains, they cannot stick with the index because they're so heavily into tech. That's why the rotation into
Right, I agree.
value
But
stocks
have you
has been more
noticed
pronounced.
that rotation truly has been magnanimous into mid cap?
Well, mid cap and small cap. Yeah.
Yeah, exactly. So the Russell.
Yeah. Ones that
Russell
aren't tied to the
2000,
dollar as much, ones that aren't tied to, high PE as much,
Right. But I noticed the dollar. Now, I was thinking the dollar could come down to 109 and then pick up the rally again. Well, it kind of gets real close, but they're holding it at 110. Again, that's their reason, not mine. I don't know. But I do see gold starting to rally. And whether they want to do it against, the movement in the dollar, that's fine. I mean,
and like I say, I mean, you're so oversold on gold. A rally is certainly not off the table because of the fact that short covering and some spec buying in a relatively illiquid market can get things going.
Yeah. But you're right. But it has to get legs. Right now, it doesn't have any.
No, because again, if this dollar gets right back above 111, 112, all these people that just did those positions that way are going to reverse themselves.
Are going to turn them again. You're right. And if you look at this, it truly is just like an ABC.
Yeah.
And it's buffeting, and this is the daily, it's buffeting up against the daily 50.
Yeah.
Both SMA and EMA.
The yield advantage is not going away when you see a 4.25 10-year and you see almost a 5% 2-year. And for God's sake,
I know.
a 1-year treasury is almost paying 5%. So, I mean, that's a rough racket to start fading the dollar, because there's got to be foreigners who are going to say to themselves, I mean, come on, that's a lot of
people
yield.
If they really want even a shorter term, look at the 13 and 26-week T-bill.
No, I'm saying they're all at fantastic 4 to 5% yields.
Yeah.
And that's with no risk of the money coming right back to you in such a short time. So like I say, that's a tough thing to fade the dollar into. And that's why you're probably correct. The dollar is in a topping process, but that process could go another 2 quarters.
Absolutely correct. Absolutely correct. And so how, see, I think there's so many times it's like we this is something else that I've talked about with other people, say, yes, we are technical traders. We are, because that's what we work with. We work with the technical picture. And also trading is quantitative. Everything is algorithmically driven. So if you don't join the party, you're going to get left behind. So I see no problem with trading technically. And the technicals, I think they're going to come times, and we're starting to see that little bit of in the markets, is where reality swamps technical and happens anyway.
Yeah, if we start hitting a recession because earnings give it up in the first quarter of next year, the first half of next year, and when the recession starts and the unemployment rates goes to 4.5 or 5.5, and you start seeing the earnings drop, and they have to drop rates or stop the hiking, and that will be the trifecta that will turn that dollar over, and that'll probably make the gold go through the roof at that point.
But consider this, right now, inflation is what, hovering still around 8%?
Yeah.
Interest rates are at 3%.
Right.
Okay, relatively. What that equation truly needs to be to create that credit event that you just spoke about is that unemployment needs to be 8%, and inflation will be 3%.
Yeah, I mean, so it's got to go a heck of a lot higher than it is now.
I think that the Fed and the Treasury will up their target. They will be forced to. And instead of saying, well, our target is 2% inflation, come on, unachievable. And I think they're going to boost it, and we're going to get a credit event, and then boom, bottom will be in, and this market will soar. And I don't think we see that.
One thing about that credit event you're talking about is that 50% of the corporate bond market, which is 10 trillion, is in triple Bs. If triple Bs are devalued, or what they call it, lowered their rating, one level, just one level, they
I hear you.
become junk bonds. And
I hear you.
anybody who's running a fund that has a mandate that they have to be an investment grade only would have to get rid of those bonds if they are downgraded one notch. And that's a lot of money being downgraded one notch. And if we're going into some kind of a slowdown, the likelihood they're going to be downgraded one notch is better than 50-50.
Right.
And
So
so
maybe that
there's,
could be, so you're right. So what direction will that credit event go in?
well, I
Oh,
mean,
you're
then
right.
you have a bunch of people selling bonds into dealers, and dealers are notorious for having no bids during volatile times.
All right.
So
I
if
think
you have
that's a
no
very-
bids, you know,
I think what you're saying right there is very important.
you're going to get a spike in
Because again-
yield.
Huh?
You're going to get a spike in yields because, you know, when everyone has
I
to dump
agree.
these things to get out and there's no bids, you're going to get a spike in the triple B yield, which feeds over into the other yields.
I agree. And
So that's
and
the
how,
risk.
and
Yeah.
how things get hedged and what happens and what goes on. I agree. It just becomes incredible.
Yeah.
Just like the rallies that we're seeing. I mean, they're deciding that they're just going to blow off all of this and they go on, well, we're going to have a year-end rally. It's like, not necessarily. So I
Yeah.
continue to just think we're correct.
Like I say, above 38.50, I'll throw in the towel that it's not going to happen. But until
I
then,
hear
I'm
you,
going to be
but
a little
I actually,
bit,
I was just a tad higher. I'm
Yeah.
38.85.
yeah, he's in that neighborhood too. But I'm saying if it starts breaking substantially above 3,800, 38.50, it's going to take out the 38.90.
I agree.
You know, because when and if it has that kind of momentum with cause, then obviously you're not going to hold it back for 50 S&P points, not with this kind of
No,
illiquidity
But
out there.
that's been the problem. You know, you see it, and you go, oh, they're going.
Yeah.
And then suddenly break, turn.
Like I
Because
say,
it's
if you see the yields back off under 410 and 390, and you start seeing the thing getting above 38.50, 38.90 is not going to hold it.
And you think, and that's this week?
I'm saying whenever it happens.
Oh, I got it. Okay. No, that I agree.
Yeah, whenever it happens, because
I
and when
agree
it
with you.
and the thing can go very fast. I mean, it can go
I
100
agree.
S&P points before you get back from lunch. You know.
I agree.
But we're going to near the top of the hour, and this is not a format where we can exhaustively go over all the information that investors might want to look at. So the stuff that you guys do and that I do is obviously a lot more exhaustive than we can do in a short time frame. So that's why it's key that the people that are listening contact us and get more information. So Dennis, how can people contact you and you give them a much more complete explanation of your views on these markets? How can they get a hold of you?
So you can find my contact details on www.CastAwayTrader.com, and you can follow me on Twitter. You can watch me on YouTube, and you can contact me by CastAwayTrader@gmail.com.
And again, you have a very unique way of viewing the Elliott Wave, which for people that are following Elliott Wave, it might be a nice combination to look at your viewpoint on it, your take, your modification of it, plus the traditional, and then maybe it'll be helpful to people that way as well.
Yes, thank you.
And Michael, again, people that want to get a hold of you, and we didn't get a time to go into a lot of the Fibonacci numbers, which I think are very important, but how can people get a hold of you? And do you have a Fibonacci, target price you can throw up there on the S&P right now and give us some targets on what things could do?
Upside, downside?
Yeah. That would be
I
helpful
can.
as we close this thing out.
Upside right now, I've got, I think it can get up towards that 3880 number, or 3800 actually.
How about if we
And
went
we're
with like
getting
a
very
daily
close to it right
1
now.
year? How about a 1 year graph kind of thing? If we could get a little
Well, the
longer
daily
term.
gives us out that 1 year, but just to go that far, I'd have to go to my weekly chart.
Yeah, go to the weekly.
And-
What is the weekly giving us? Yeah.
A weekly's giving it to me that it might get up to 38.25 to 38.50. I don't
Okay.
really see it going too much further. So I agree with you there. Downside target for the S&P, 3,100 to 3,000. But I think ultimately we drift down to about 2,800. And then we begin an extremely exciting and dynamic rally phase. Now,
And
don't
people
wanna
want
get a
to
hold
know,
of me.
Michael, people want to know how you get down to that number. It could be something like the earnings are cut by 20%. So now you're at $1.70 on S&P earnings, and the PE ratio goes down to 14 or 15. And that's how you get down to those lower numbers. So people
I
will probably
agree.
wonder, how
I
would
think
you
it
get to
will-
those
I think
lower
it will be
numbers?
triggered, but I think
Yeah.
it'll just be a continuation. So I think that
Yeah.
a lot is sitting right now on CPI that's going
Yeah.
to come out on Thursday.
Yeah.
And then we'll take it from there, because after
Yeah.
CPI, next week we got PPI.
But
And then et cetera, et cetera. We
2023,
still
yeah,
have a few earnings to come
2023 earnings are going to really tell the tale, because if we have higher
Amen.
interest, like if you're talking the Fed's going to raise their terminal rate towards 6, maybe that's going to be constrictive on the PE ratio. And then if they have to cut the earnings because the economy's slowing down, that's the double whammy that would give you the lower levels you're talking about.
Right. I agree.
Yeah.
But back to getting a hold of me.
Yeah, absolutely.
You can email me at michael@mjf1partners.com. I answer all my emails. If you have a question, if you need more information, I provide coaching. I have a trade room, and I also produce a daily update on both the S&P and the NASDAQ. That would be Sunday through Thursday. And so I go over the day's actions. I go over any changes to the big picture, but mostly I take it all the way down to a 5-minute chart, because most of the people that are coming in are kind of looking for a day-to-day type of a view. That would be on Traders Helping Traders within YouTube. And then you must look for my name because I'm still dealing with somebody who's hacked Traders Helping Traders, which I own, and they've managed to run with that. So it's my name under Traders Helping Traders, or just search my name on YouTube and you'll come up with my pages.
Sounds good.
And thank you very much.
Perfect. As far as optionprofessor.com is concerned, that's the website for me, optionprofessor.com. And if you go there, you can get information on our PDF report, which is very important. We've talked about for 3 years now, how to protect your portfolio against market declines with option strategies, but also protect yourself against upside surprises. And so there's a number of option strategies that can be used, and they've been extremely helpful for people that have been aware of them. And so we also have a weekly newsletter we send out. You'll be eligible to get that as well. So that's optionprofessor.com. Okay, thank you, Dennis, and thank you, Michael. Again, there's a lot to go over, so it's important for people to reach out and get a hold of you guys so that they can get a full, complete details on how you guys do your analysis. Right now, I'm going to be sending it back to David. And again, thank you guys for being here today.
Thank you.
All right. Thanks, guys. Great discussion. So just a quick reminder, be sure to subscribe to Timing Research on YouTube and your favorite podcast app. Or you can also just go to TimingResearch.com to get any of the past shows and presentations there. And just want to thank my guests again for today. Dennis of CastAwayTrader.com, Michael Filighera of LogicalSignals.com and TradersHelpingTraders.com, and the Option Professor of OptionProfessor.com. Thanks, everyone.
Thank you.